my name is Christina, and today we will talk about dead cat bounce. One of the popular terms that traders often use is dead cat bounce. The term comes from an old saying in investing, even if a dead cat will bounce if it's dropped from high enough. The expression describes a situation where a security has a short-lived burst for an upward movement in a declining trend. It is a temporary rally in the price of a security after a major correction or downward trend. A dead cat bounce is very difficult for analysts and traders to predict. It begins with a downward move followed by significant price recovery. However, after some time the price doesn't rise anymore and the downward trend continues, falling even further. Because of this, traders sometimes open long position and hope for a trend reversal, which never happens, falling into what is called a bull trap. In order to explain when a dead cat bounce happens, it is good to look at an example. Let's say there is a security name X price at RS10. In the past 7 weeks, the security has been declining and its price fell to R2 level. In the 8th week, the stock rises and goes to RS3, but the following week it falls again to RS1. On reflection, the jump in the price in the 8th week will be termed as dead cat bounce. Dead cat bounce is pricing pattern used by stock analysts to determine whether a rise in the price of stock after a major correction is a reversal of the decline or just a dead cat bounce, a temporary bounce back of the price. Dead cat bounces are usually observed in retrospection as it's very difficult for traders to detect them from a simple trend reversal. More often than not, such a sudden increase can be caused due to bargain buying by traders and investors who may mistake the bottom of the stock price. Short-term traders can take advantage of a dead cat bounce and make profits from the short rally. Stay tuned for more interesting and useful market terms.
Hello everyone, my name is Emily and today we are going to talk about the affiliation program. So what is an affiliate program? To simply put it, an affiliate program is an agreement in which a business pays another business or individual a commission for driving traffic or sales their way. Within the world of forex trading, this involves a forex broker and a forex affiliate, with the affiliate referring clients to the broker. So how does this work? Firstly, you register as an affiliate with IronFX. Then you share your referral link with your network on your website or your blog. Then you get your client to click on the link, register with IronFX and start trading. And then last but not least, you receive a commission. Now the question is how to join our affiliate program. The first step is to register as an affiliate in the IronFX portal. Then you have to log in to your affiliate portal and get access to a wide range of marketing material. Then you get your referral link and use the promotional material on your website or other. And last step is you start earning commissions through one of the most popular forex affiliate programs for each client you refer to IronFX. Thank you so much for joining us today, guys. See you tomorrow. Bye-bye.
Okay, all right. So let me begin today's session. Today's session is on top trend indicators. Okay, it's there are a lot of ways to trade trends, right? There are a lot of ways to trade trends out there, and it's one of the most profitable trading strategies. When you're trading trends, there are two things you can do. Let me see. I can pull out my my pen over here. When you're trading trends, there are two things you can do, right? You can, when there's a trend, you can either continue to play the trend, right? Or you can, so this is one way, you're playing the bounces, you're playing the bounce, you're playing the bounces over here. So this is one way that you can trade, to make money. Hey, Natalia, nice to see you tune in. And there's another way of trading trend, which is, when there's a trend, you play the breakout over here, right? So there are essentially two ways to trading the trend. Both are equally profitable, but it's very tricky. Many times we think that we're going to play a breakout, then it comes down, then it comes back up here, right? It comes back up here. So you end up losing money, right? So sometimes, we think that we want to play the bounce, then it end up breaking out, and we end up losing money. So there are many times when this happens, right? And we need to ask ourselves, right? How do we reduce the chances of that happening? Yeah, right. How do we reduce the chances of that happening? How do we reduce the chances we get freaked out here? When we think it's going to bounce, then it breaks out. Or in this case, where I think it's going to break out, then it bounces, right? So how do we avoid that happening, right? So in today's webinar, right, I'll be showing you some of the ways that I've done it myself, right? And to really increase the probability of my my trend trades working out nicely. Okay. Now, guys, if you're here, what I'd like to encourage you guys to do is there's a chat panel that's open, right? I can see a couple of people sending messages through, right? Feel free to send your messages in there. I'm going to send my message one more time. Hi, right? So send your messages in there. So I literally have another screen open on my left, right? That is monitoring these questions. So if you have questions, just send it through. I'll do my best to get to them, right? Don't wait until the end of the webinar. We might not have time to answer these questions. Anytime you encounter anything in the webinar where you're not sure about, just let me know. I'll do my best to answer them. Okay. And of course, feel free to send any messages in there. Even if you want to chat with me, right? Go ahead, right? Because otherwise you feel like I'm talking to myself, which is very sad. Right? It feels like I'm going to talk to myself, right? So yeah, it'd be nice to see you guys. Hearing a little bit of stuff from you guys. Maybe for starters, if you can let me know which countries are you guys tuning in from, right? Which countries are you guys tuning in from? Because in Singapore now it is 6 p.m. right? It's 6 p.m. here. So I'm just wondering where you guys are tuning in from. Oh, Kurt from UK. So UK is about, what is it, like 9 a.m. there? Oh no, it's about 10 a.m. there now or something, right? Now, I always liked the idea of going to 11 a.m. right? I always thought people who live in UK, they're so lucky. They get to watch the English Premier League. Anytime they want to watch Manchester United, they want to watch Chelsea, Liverpool. They can just the idea that can watch like the matches there, just so great, man. In Singapore, we hardly have any like football worth watching. Hey, Joshua from Nigeria, good stuff, man. Good stuff. Hope to visit there one day, right? Anyway, guys, I can see a couple more of you guys slowly streaming in. Nice to see you guys here, right? Let's begin today's session now. Remember, disclaimer. Everything in this webinar is educational in nature, so nothing should be construed as investment or trading advice. Please do your own little due diligence before you guys trade. Okay. Oh, someone in Singapore, right? Singapore. I'm not sure if you in your 7 hours stopover, did you manage to check out the Jewel, right? Singapore has this thing called the Jewel. Is right in the airport. It's a huge place, right? Let me see. A Singapore Jewel. Not Jewel, not jewelry, right? It's actually just Jewel. Yeah, Singapore has this place. It's called Jewel, right? This is literally in the airport, right? You can see like there's the airport around here. It's this massive dome. It's called the Jewel, right? So if you ever stop by in Singapore, do check it out. It's a really, really awesome place. I think we have the world's largest artificial waterfall over here, right? So yeah, it'd be good if you guys stop over, let me know, right? We can catch up for a meal or something. Ishmael, nice to see you tune in too. Good stuff, man. Thanks for tuning in nice and early. Let's begin today's session. All right. So anyway, those of you guys who are here for the first time, a quick introduction to myself. My name is Butterfly House. Yeah. All right. So anyway, my name is Desmond. I run the award-winning research firm, Everest Fortune Group, and also the Forex Army. Right. We are finalists for Best FX and Best Equity Research 2019, 2020, 2021. Right. So I run a strong team of prop traders. Right. We usually work with the major financial institutions, telling them where the markets are heading. But we have a special partnership with IronFX where we're bringing guys the good stuff, the juicy stuff, the stuff that'll take your trading to the next level. Right. So in today's session, it'll be a fun time. I'll be showing you how the pros use the different trend indicators out there as a confirmation, better ways to improve the probability of playing the bounce or playing the breakout. Okay. Now let's begin today's session. Okay. Now the agenda for today, I'm going to show you, I'm going to talk a little bit about trend indicators, right? We're going to look at the 5 most effective trend indicators. I'll talk about implementing it into a strategy. How do you play the breakouts? How do you play the breakouts and how do you play the bounce? The reversals rather, right? So just so that we're on the same page, breakouts are when prices breaks out of a certain level, right? Bounces is when, price bounces up from here, right? So there are 2 ways to play trends. One is, you go with the trend is your friend. The other is you play the breakout from the trend. Okay. So these are, these are important things that we can do. We'll be exploring today, right? So on to the first, introduction to trend indicators, right? So there are many trend indicators out there, right? All of them kind of one way or another, right? There's stuff like the Ichimoku cloud, we call it IKH. There's some moving average indicators. There's stuff like even the MACD. MACD actually measures once it crosses the signal line in the middle, right? That's where it's a little bit picking up of momentum, right? There is stuff like, for example, a moving average crossovers, right? There is the ADX, right? ADX, very useful indicator if you know how to use it correctly. ADX, you can use it. It measures the strength of a trend, but it's usually a little bit slow. It's a little bit, it's a little bit slow when it comes to using the ADX in measuring trends. So I'll be showing you one of my handy dandy, what's the word for it? Handy dandy indicators, trend indicators I use that have worked out pretty nicely in the past, right? And I still use it up to today. Okay. Now, a few important links that I want to point you guys to before we begin. All right, IronFX.com. You want to go to for the upcoming webinars. You want to go to you just need to wait for the drop down to appear. IronFX School, right? You want to go to webinars, right? So under webinars, this is where you get to see all the upcoming webinars. What you can do is you can click on English, right? They can see, right? These are introduction trend indicators. Tomorrow's a live trading session. Me or Cassandra would be taking it. So go check it out. All right, we got advanced moving average strategies next week. If you want, please go register for it. I'm just going to copy the link here and send to you guys. Right, go register when you have the chance. Okay, this is advanced moving average strategies. Will be an expansion of what we're doing today, right? But it's a really great way I can show you how to use moving average. Pretty fun in a pretty nice manner. Oh, cool! The webinar is live now, right? So this is the first thing you can go place. The first place you can go to. Second is these past webinars, right? Past webinars, a great place for you to catch up, right? This is me, Cassandra, a couple of new people coming in, right? This is where you can watch, like you click on English, you can watch all the previous webinars we did, fundamental, technical, support and resistance, right? Great place for you to learn all the previous stuff we taught about, okay? So go check it out over there. Now let's begin today's session, okay? Give me a second. Sometimes I talk too much and my throat hurts. All right, so let's go. The first thing is the Ichimoku cloud, right? the Ichimoku cloud is one of the best indicators when it comes to trend. Now, there are two kinds of, let me see if I can pull it out over here. There are two kinds of, when you use the traditional Ichimoku cloud indicator, right? I'm going to show it to you over here. Usually, when you use an Ichimoku cloud indicator, it comes like this. This is how it looks like, right? And this can be quite overwhelming. If you look at it, right, there is the leading, the Chico span, right? The the leading span, all the different kind of like basically conversion based lagging, leading A, leading B, right? So there are all these kind of different lines, and it can be a little bit overwhelming when you look at the Ichimoku this way. So a lot of people, when they try to use Ichimoku, what they don't like about the Ichimoku is that because of all these lines, it makes the chart over cluttered, right? It makes the chart over cluttered. So what you can do instead, right? What you can do instead is actually you can click on this setting, remove everything, and just leave the background. Leave the background as it is, and this is good enough, right? This is good enough for trading simple trends, right? You notice how it works very well when price tends to be trending in area. You can see how price tends to respect this area. When it breaks this area, it kind of goes down, right? When it breaks this area, it goes up. It failed to break this area, come down, failed to break this area. So price does respect the Ichimoku in some ways, right? It doesn't work that well if it is like in a ranging market, right? But when it starts to trend, you can see how crossing below, you could catch a very, very nice trend all the way down. Of course, how do you get out at the bottom? How do you get out at the top? This is a topic for another day, right? But you can see that the Ichimoku can be used as the Ichimoku cloud, right? Over here, it can be used as a great way to trade the trend, but you cannot use it by itself, okay? You cannot use it by itself. Ichimoku is weak when the cloud is small. Look at the cloud over here. It's small, it's small, it's small, it's small. It's not that great. It's very thin, right? So if the cloud is too small, it's not that strong. You think about it, when it's raining, right? When it's raining, if you have a huge cloud up there, you got a lot of rain, right? But if you have like small little clouds in the sky, right? It's not that great, right? It might not even rain. So when there's a big cloud over here, that's where you can see price tends to work very well. Even when there are big clouds, now this is a trick, right? There's big clouds on here, big clouds on here. But if price tends to cut right through the two clouds, right? This is actually a trick that sometimes people don't realize, right? They're like, oh, there are big clouds over here, there are big clouds over here, but they don't realize that price can sometimes just cut right through the clouds. Imagine you are, you're Superman over here, you're flying, right? You fly through the clouds, right? When you fly through the clouds, then you don't get wet with whatever clouds are over here, right? So that's a trick when it comes to Ichimoku. Just because there might be a big cloud over here and a big cloud over here, right? If you actually cut through the weak point, right? That's actually a one way to break through the resistance or support, right? One consideration for you guys to take note of. When they get caught in a cloud, it tends, you could see stuff like that where price is fighting and caught within the cloud, right? So the Ichimoku is a great supporting argument, right? The key word here is supporting. It is not a trigger. It is a supporting argument, right? That means it is used to complement your trading analysis. It's never used as a trigger to enter your analysis because the Ichimoku is still a little bit lagging, right? It's not as accurate as some of the other stuff which I'll be showing you in a bit. It's more used as a lagging indicator, right? As a supporting argument, okay? A supporting argument. All right, so yeah, this the first thing I want to show you is Ichimoku. I guess we can scroll back a bit and we can see like how the Ichimoku performs. You notice that in times where it's ranging, right, it really doesn't perform very well, right? You can cross below, cross on top, cross below, cross on top, cross on top. But yeah, once it breaks the key level, right, and that's where it could open a bigger move down. Just looking at Ichimoku cloud will help you trade better, right? Of course, the key thing here is that don't just use it as your main form of trading, okay? Don't just use it as your main form of trading. Let me just see if I can draw an example over here. I do have some examples drawn out, right? Yeah, I have some examples drawn out. I'll see how I can show it to you in a bit, right? I know we do have some examples here. Very nice channel break. Could be. Never mind, right? I prepared some for us to go through, right? So anyway, the Ichimoku cloud is one of it. Let me show you the next thing, right? The next thing is the golden and death cross, right? The golden and death cross. They are actually called the 200 and 50 SMA crosses. So this is when the 50 moving average here is the goal line, and the 200 moving average is the black line, right? So when this happens, right, when the 50 crosses below the 200, this is what we call a death cross. So usually when this happens, right, actually is the start of prices kind of going down, right? And when the 50 moving average crosses above the 200 moving average, this is where you call it a golden cross, right? And that usually speaks to the start of a very, very nice uptrend. Now, there are ways for you to get out of a trade before this happens, because most people who trade the golden and death cross, one of the problems is that when you imagine when the cross happens here, you get in here. If you wait for the cross to happen over here, which is over here, look at how much of the trade you have given away, right? You got in over here, right? Which is about over here, right? You end up making this much. Maybe if you're lucky, you make this much money, which is crap, right? It's not that much, right? So there are actually other ways where you can get out of the trade. If you got it, you could actually have caught all the trade all the way down. This would have been your maximum potential. This, you could have made this much instead of this much over here, right? So how do you get out of a trade before, like maximize the most out of a golden and death cross? I'll be showing you guys how to do it in a bit. Okay, now golden and death cross, right? How we can actually look at some of the golden and death crosses here. So I have an indicator that just loads the MA 50-200. You can see it kind of works out well most of the time, right? So there are the downside of this is there are false signals, right? You could have something like this, when you have a death cross, you think it's going down, it goes up, it cuts you out, right? And then it goes down another time. But if the one time you do catch it, right, it goes all the way down very nicely over here, right? You can see go down, go down, go down, go down. It's a nice big move you're catching, right? It's a nice big move you're catching. There are other times where, cross up, by the time you think you're going up, it starts to cross down over here, So this part is where this is the problem with, this is the kryptonite of the moving average crossover, is that in a rangy market, it will completely, wipe you out. But if you catch it at a good time, like this, you can write a massive move down, right? All the way until it gets out, maybe over here, right? Most of the time, each time you get one massive trade like that, you might get multiple trades where you get wiped out once, wiped out multiple times, right? So this is an important, how do you avoid stuff like that? How do you avoid stuff like that is part of what we'll be covering today, right? It's what I call indicator confluence, right? Using multiple things to really improve the accuracy of your trend lines breakouts. Okay. Next thing I do want to teach you guys, right? I'll be showing you guys right now. On top of the golden and death cross, which uses the 250 moving average, is the price times moving average crossover. So I know it sounds quite simple, right? Price, as you can see over here, crossing over the moving average very nicely. Then it goes on a nice little journey all the way up, all the way up, all the way up, as you can see over here. This doesn't happen all the time, but it happens enough, right? Moving average crossover, you take a trade, it goes all the way up, right? So this is one of the nicer, very simple, and it's oversimplistic, right? So this is where I'm going to show you guys another method, which is called the before this, right? Before the natural moving average, another very, very nice indicator that we use are channels, right? The key thing to focus about channels is that you need 4 touches, right? You need 1 touch, you need 2 touch, at the bottom minimally, and you need 2 touches at the top. Or you can consider this another touch, right? So only when you have 1, 2, 3, 4 touches, then it becomes a channel. 5 touches is still a channel, and this is where you can kind of play the bounce, right? So what have we covered so far, right? Now I'm going to show you how it all comes into play later when we combine them together, right? But you can see we have the Ichimoku cloud over here. That's number 1. Golden and depth cross number 2, right? Price times moving average cross over 3, right? We got channels number 4. The fifth one, the fifth thing that I wanted to teach you guys is actually the natural moving average. This is actually one of the key parts of what we're going to cover today, right? Because it's a concept which very few people know about, and very few people know about. All right. Now, in this example, which looks better, A or B? Right. This is a moving average from A. This is a moving average from B. Which looks better? Do you guys want to try to just put in your answers a bit? Kurt, I'll answer your question in a bit, right? Does anyone take a guess which looks better, A or B, when you're looking at the moving average? I see some people answering privately to the panelists, right? Some people are saying that A looks better, right? A looks better than B. Right, here you got Kurt saying that A looks better. Okay, most people are saying that A looks better, right? Actually, I got a couple of answers coming in saying that A looks better. Okay, so A looks better, right? You think about it, look at it over here. Bounce nicely once, bounce nicely twice, bounce 3 times, 4 times, 5 times. When price breaks this moving average, it goes down, right? This one it catches once, it misses it by a bit, as you can see, misses it by a bit, as you can see. It catches 2, catches 3 times, and it reverses from there, right? In fact, this one catches the reversal slightly better than this one, right? So we can agree that A is better than B. A is better than B, okay? Now, let's take a look over here, right? So this happens to be the 46 SMA, and this is the 50 SMA. That is an interesting thing. This is a 46 moving average, and this is a 50 moving average. Most people, when they trade, they use a 50 moving average without a second thought, right? They're like, all right, I'm going to put a 50 moving average in there, right? And yeah, they use it to trade. They don't realize that all they need to do is to tweak their moving average just by a bit, right? You know, and you're able to get a much better kind of a moving average that catches more of the bounces. More of the bounces and probably gives you a better indication of a breakout, right? So this is what we call the natural moving average. Because if you think about it, no one has ever said that the market obeys a 50 moving average or a 100 moving average or a 200 moving average, right? No one ever said that. Those are just numbers that people throw out there, right, for the sake of convenience, right? What's a 50, what's a 100, what's a 200 moving average? No one ever said the market will explicitly obey that moving average, right? So what can happen instead is when you have a moving average like the 50, you try to fine tune it a bit, lower it by 1, lower it by 2, lower it by 3, lower it by 4, right? Until you can find the natural moving average where price most closely is able to catch the bounces, and that will be your natural moving average, right? The natural moving average is always changing. I can show it to you over here, right? Let's see if I can show it to you over here, okay? Indicator, right? We're going to throw a moving average, right? And we are going to maybe tweak this to 200. Okay, look at this. 100 moving average. Price touch it once, go down. Price touch it twice, go down. Touch it 3 times, goes down, until it finally crosses it, goes up, right? So look at the bounce over here. Okay, this is the 100 moving average. What can we do? You know, at this stage over here, maybe you can see that you might have got faked out and crossed down before going up. Okay, let's see if we can tweak this a bit, right? So in this kind of case, right, when price is over here, right, I'll be saying looks a little bit fishy. 110. Nope. Maybe 120. Nope. 115. Maybe 113. Right. This could be a better indication for your moving average, right? So in this case, you can see how you are able to capture, you know, when you capture the tops over here more accurately, right? More accurately, it prevents you from being as badly wicked out previously than this. Okay. Now I do. You would not have noticed that, you know, it caught the bounces here nicer, and when the crossover happened, you know, it gave you a much better indication of price dropping, right? And if you're really trailing it, you know, you wouldn't get stopped out. You wouldn't get stopped out, right, all the way down. Of course, right? If you look at it here, right? So this is let's take a look here. You know, you realize that nice is right about there, right about there, right about there. What happens when you do at the 100 moving average? You can see on the 100 moving average, this part over here, right, is not as nice. You know, it actually closes below the 100 moving average, right? And you might have got stopped out unnecessarily, right? So it doesn't capture it that nicely, right? It's all about, so we got people asking like what moving average to use on a daily chart. The trick is to use a moving average that catches price. Use the standard 50, right? You got 100, we got 200, and then you fine tune it from there, right? You need to fine tune it to get the natural moving average, right? Let me show you some additional examples, right? Let me show you some additional examples over here, right? So let's just say, usually a trend. So I'm just trying to pick up the best example. Maybe you do the 200 moving average. Let's go for something like the 200 moving average, okay? Now, let's see, in this case, the 200 moving average, you know, you might have been able to trade it very nicely, right? Seeing how price, you know, reverse from there, reverse from there, reverse from there, right? Reverse from there. You will notice one thing though, when you're using the 200 moving average, I'm going to zoom in here. Look at how many times like price closed above the moving average, right? Close above the moving average, close above the moving average. If you were using a close above the moving average as your indication to get out of a trade, man, you would be in for a tough time, right? You will have closed out the trade here once, close out the trade here twice, close out the trade here 3 times, close out the trade here 4 times, because each time price closed over the moving average before dropping down, correct? So a natural moving average in this case, right? So in this case, if you use it over there, right, you would have, maybe you were saying that, okay, price reverse, right? And then you're trading from here. You think that price is gonna break up from here. You want to go long, but it goes down, right? It goes up again. You think it's going to go long, it goes down again, right? So you end up losing a lot of money when it comes to this moving average. But if you, with this data over here, with this data, if you were able to fine tune it, right? So let's do it like maybe 210, 220, 215. Yeah, 223 over here, right? So you can see how it, you know, it caught the wicks there slightly better, right? I mean, it's still close above over here, right? But it caught the wick here nicer. And then this would have been your profitable trades, right? If you look at this over here, right? Price reverse from there, reverse from there, reverse from there, right? This would have been an even more profitable trade for you, right? All because, right, you fine tune your moving average, right? You fine tune your moving average to go from 200 to 223. I know it sounds a little bit unconventional that your moving average is not 200, not 100, not 50, but this is the trick to it. You know, when it comes to natural moving average, no one ever told you that the market will obey only a 100 or 50 or 200 moving average, right? The market behaves however it wants to. It has its own moving average that it can use, right? It's up to you to find the natural moving average and use it to your advantage, okay? Now we of course have a question from Kurt. How close does the price action have to be to the channel to be classified as a bounce, right? I think you were looking at this part over here, right? How close does price action have to be to the channel to classify as a bounce? Now, the thing about price action, right, is that I'm going to write the word out here. Price action are like essentially like almost like candlestick patterns, right? Price action only happens in the tick of the action, right? You need things to be going on for it to be considered price action, right? So only when the bar forms, right? Only when the bar forms, then you can consider that, yes, that's where price action has happened, right? How close does the price action have to be a channel to be classified as a bounce, right? Usually, right, it needs to at least touch the, what's the word for it? It needs to at least touch one of the parts of the channel, the lower bound or the upper bound, right? So it is important that it touch the channel, okay, as that is when the key deciding point happens. But always take note that you don't need to be too strict on that rule, because when it comes to channel trading, right, channels are essentially trend lines and they're not that accurate, right? Why are they not that accurate? Is because of this. Let me see if I can show you an example over here. If I had a trend line, see, if I had a trend line from here, right, and from here, all it takes is for my price to move by a bit, and my ending point will be very different, right? So if my ending point is here versus my ending point over here, right, it all looks very, very different, right, based on my ending point. So trend lines, all it takes is just a little bit small movement, and bam, this is now now not a breakout. This is a breakout, right? So when you're trading with trend lines and channels, a channel, right, like I said, a channel is just two parallel trend lines. And the problem with channels is that they are a little bit unreliable, right? So where'd they go? Yeah, the problem with channels is that it is a little bit unreliable. All right, so the channels are used more as a gauge, more as a gauge to know that, okay, price is moving up, it's bullish momentum, I'm looking for bullish reversal. Don't use it as the confirmation, right? Don't use it as the confirmation. It rarely ever works well. Okay, I hope that answered your question, Kurt, but if it didn't, let me know. I will try to answer it better. Okay, now, so there's another thing that I want to show you guys, right? Oh, sorry, right? Beyond the natural moving average is that, yes, if you tweak your moving average by a bit, you might be able to find a much more accurate setup, right? You might be able to find a much more accurate bounce or a breakout that can happen, right? So don't hesitate to tweak your moving average just by down and up a bit, and try to catch as many bounces and reversals as possible to improve the accuracy of your moving average. Okay. Now this is an example of having a double confirmation for your channel breakout, right? So usually you have a channel breakout, right? But this time you have a channel breakout and you have a moving average breakout. Okay, so you can see how price over here, it broke out from that level. So if it were to break a channel, and if it were to break a moving average, or rather a natural moving average, it goes from a low probability trade to a medium probability trade, right? So you can see how price really broke nicely from here. There we go. And price comes all the way down to here, right? And you can see how the breakout worked out very nice. But this is a double confirmation. It's called a double break. So it did not only break the channel, but it also broke the moving average. So that gives us additional confidence that the break is successful, and it should drop very, very nicely. Which it did over here. So one of the tricks to do is, of course, combine your channel breakouts, whether it is channels, whether it is moving averages, whether it is channels, moving averages, trend lines, those are things that you can, if you combine it, it's okay. So you can see how the drop worked out very nicely from there. All right. So now I do want to show you this concept of confluence. Okay, so this is a chart you can see over here. It's a channel. You know, you got 1 touch, 2 touch, 3 touch, 4 touch. Yeah, correct. Yes, the user channel more as a gauge. Gauge of the trend. You know, it's not just a you know, it should not be used to confirm your entry. Okay, so your price action does not need to be that close to it, right? 5 touch, right? Yeah, it's doing good. This trend line is great, man, right? I mean, this channel is great. On top of a channel, right? So you're expecting prices to continue going up, right? And then you throw on a natural, I call it the NMA, natural moving average, right? So then we can see, you know, price bounce up, bounce up, bounce up quite nicely. So it is a natural moving average. You have a channel, you have a natural moving average. Okay, then you go down here, right? You have Fibonacci confluence. No, I mean you got an Ichimoku cloud, right? Ichimoku cloud showing that, whoa, there is not only a channel, right? There's not only a nice little moving average, natural moving average that's supporting price, but you also have an Ichimoku cloud. So there are 3 reasons why you're bullish over here. Okay, and then you have the last one, which is your golden cross. You know, before this whole thing happened, you had the golden cross, which was a long-term sign that the short-term moving average, has crossed over the long-term moving average. When this happens, right, is what we call a golden cross. That is a sign that price is going to continue rising for a long time. Okay, so we have the momentum of the golden cross, we have the momentum of the channel, we have the momentum of the natural moving average, we have the momentum of the Ichimoku cloud. All of them combined, they give you a much a high chance of price working nicely in your favor. Okay, so you see from here how price, you know, from here we're expecting prices to bounce up, right? We can see how price actually did touch this level. Right, this touched level and did bounce up nicely as part of the whole concept of confluence. Because guys, you know, when it comes to trading, it's not only about using one thing. You don't just use channel and you trade. You don't just use Ichimoku and you trade. You don't just use moving average crossover, then you trade. You know, you don't just use natural moving average and then you trade. Right, you combine it all together, right, to give yourself the highest chance of getting the trade right. Right, all comes down to a confluence of reasons, right? Don't trade a single strategy in isolation. Combine multiple of them together to increase your chances of getting a profitable setup. All right, guys. So there's one thing I want to encourage you guys to do. If you're here, right? I know Natalia, right? I've said it before, right? But I think, yeah, they are still preparing the landing page and stuff, right? Please go over to vip.ironfx.com, right? This is the link that I'm going to give to you guys. Right, vip.ironfx.com is a place where you can practice your analysis, right? I know we're officially not super duper launched yet, right? It's supposed to be launched within the next week or so, right? So that's why I haven't posted a lot of stuff in there. But when you're in here, right, the nice thing is that you can come in here when you register an account, you're able to actually ask me questions, right? So maybe, right, you are looking at euro dollar. You're looking at euro dollar and you're wondering, hey, you know, has this breakout happened, right? And you know, is this a valid trend line? You can just come in here and say, hey, Desmond, right, is this a valid breakout and also a valid trend, right? So what's a valid breakout? Highlight this word, link object to text. You can select the object that you just drew. And what's a valid trend line? You highlight it, select link object to text, select the trend line, click confirm. You can send the message through. So how it looks like when someone reads the message like, hey, Desmond, is this a valid breakout? When they hover the mouse over it, they can see, oh, this was the breakout you were referring to, right? And this was a valid trend line that you're referring to. So I can say, all right, this is lit, right? I'm going to give it a fire, right? I'm going to view discussion. I'm going to have my own separate discussion over here, right, saying that, hey, you know, maybe something like that. looks like a cup and handle, maybe cup and handle, right? Highlight this, link it to whatever I just drew, cup and handle, send the message, right? This is the cup and handle that you're looking at, right? So it gives you a lot more opportunities to practice your analysis. Okay, so if you have an IronFX account, you will get access to it. You just need to sign up. All right. Now, all right. Let me see. I have covered most of my what we need to cover for today in today's webinar. Do let me know if you have any other things. Right, I am looking, right, for some of you guys who want me to do some analysis. Right, I am looking at this particular movement here. Looks like a change in the trend. Right, this is how I do my analysis. You know, prices bounce up, bounce up, bounce up, bounce up. 1, 2, 3, 4 critical bounces, right? So when you have 4 critical bounces and this happens, you start to have a low-key kind of panic. Same time, you throw on the moving average, Ichimoku. It has crossed below the Ichimoku. One reason, right? 2 reasons why it might drop, right? For on top of that, right? This little swing low support broken, right? Might be dropping further. Another important reason that we might be looking at, right? Then we look at maybe the moving average, right? Nothing much in the moving average, honestly, right? It's not clear at all, right? But we have 3 reasons here, right? We got the trend line breakout, right? We got the Ichimoku breakout, right? And we look like we have like a support level breakout, so it could trigger a move down, maybe even all the way down to here. Okay. Now, guys, thanks for staying throughout this webinar to listen to the concept of using trend indicators, right, to trade better, right? Do remember, it's not about, right? It's not about just trading in isolation. It's not about just using the Ichimoku, using the trend lines, using channels, right? Using natural moving averages, using golden and death crosses. It's about combining them together, right? So example, in my example over here, in my example over here, right, it's a combination, right? It's a combination of not only the moving average, it's a combination of the Ichimoku cloud, right? It's a combination of the, what is this called? A golden cross, right? It's a combination of the channel, right? So we got 1 reason, 2 reason, 3 reason, 4 reason, giving us nice little thumbs up, right? To confirm us that this is a nice trade and that you should maybe risk like 2% on the trade, right? So this, I mean, this is not financial advice, but this is what I mean by that. If you had 3 of the 4, maybe this is 1.5%. If you only had 2 out of the 4, maybe it becomes 1%, right? If you got only 1, right, then you don't trade at all, right? So that's the approach you should take to confirming the different trend indicators, right? Use it in your trading, right? Use it as confluence and confirmation all together, right? So Sonta is asking how to get recordings and other recordings of webinar, right? I'm going to send a link to you, right? Just head over to IronFX.com. Actually, I can go to IronFX YouTube, right? We can go to playlist over here, right? We can watch the webinar series, copy paste this, right? So you guys can go check it out. All the past webinars are there for you to go through. Okay. It has been a great time hanging out with you guys. Thanks for staying, Summer, Sonter, Natalia, Kurt, Ishmael, Gabe, everyone else, right? Thanks for staying throughout this entire webinar. I hope you found it useful in helping you be a better trader when it comes to trend trading, right? To open your perspective to the different momentum indicators out there, different natural moving average, how you can combine multiple things together to give yourself the best chance of being a profitable trader, right? So that's the key thing that I want to you guys to take note of, is that never trade a single indicator in isolation, right? That's why I gave you 5 indicators. Combine them together to give yourself the best odds of being correct. Okay. Thank you very much, guys, right? Stay safe, trade safe, peace out, right? Thank you, Natalia. I'm glad you like it, right? I hope you guys, the rest of you guys also like it, right? Do tune in for tomorrow for our live trading session. Thank you very much, Ismail, right? Kurt, yes, I think we got approved already, right? I just need to, I need to send it back to you. Good point. Thanks for the reminder. I'll get you access to the VIP room and the candlestick indicator. All right, guys. Thanks very much. Take care. Yep. Thank you very much, Kurt. VIP room, summer goal, right? Is this thing over here where you can come in and you practice the analysis and you can get our exclusive, like high probability kind of research, right? To be good, that you can use in trading, right? So go check it out. I'm going to send you the link. Go register for a new account over there, right? Summer, go register for a new account over there. And as long as you have an IronFX account, you should be able to get access, right? Just remember, click on this thing called request access and let me know what is, send a screenshot of your account, okay? That's it for me, guys. Stay safe, trade safe, peace out. I'll catch you guys next week. No, I'll catch you guys tomorrow for our live trading session. It might be me, it might be Jane, it might be Cassandra, but I will let you know. Okay? Take care, guys. Bye-bye.
Hello, my name is Christina, and today we will talk about scalping. Scalping is a day trading strategy that involves making small profits from a high number of daily trades. In other words, a trader will make tiny, incremental gains that add up to a large profit instead of big gains from a small number of trades. This is achieved by going in and out of positions a number of times within a single day. Scalping is a very intense form of trading that needs full concentration. It involves holding trades for just a few seconds or minutes at the most, making the quickest form of trading. Scalpers take profit early if the market moves favorably and minimize losses by closing positions very quickly if the market turns. To maximize chances of success, scalpers look to place trades in line with a trend and often use technical indicators as well as acting quickly on releases of economic data and other news events. Scalpers generally choose to trade on highly liquid markets as this allows them to enter and exit positions quickly. It can also help reduce the cost of speculating on small price movements as liquid markets often have lower spreads. Scalpers make trades according to data from trick charts or 1-minute charts. Day traders go after profits involving dollars and cents per share or unit, while scalpers aim to make lots of gains on trades involving fractions of cents, between 5 and 10 pips. When trading on standard lots, these tiny gains all add up. For example, the average made on 1 pip for trading one lot is $10. For 5 pips, $50 can be made on a single trade. Stay tuned for more educational videos.
Hello everyone, my name is Emily and today we're going to talk about hedging. Hedging is a risk management strategy which is applied to offset losses in investments by taking an opposite position in a related asset. Basically, hedging refers to reducing some sort of risk or exposure that could negatively impact your portfolio. It can be the risk of a specific stock or an industry experiencing a decline, the risk of interest rates rising, or inflation being higher than expected. Essentially, you can hedge by adding investments to your portfolio that move in the opposite direction. For example, you could hedge your exposure to a specific stock by shorting that same position. In doing this, you offset your loss, so if the stock drops in value, the short position will increase in value. Hedging strategies involve the use of financial instruments known as derivatives. Two of the most common derivatives are options and futures. With derivatives, you can develop trading strategies where a loss in one investment is offset by a gain in a derivative. Moving on to the benefits of hedging. Risk mitigation. The main benefit of hedging is that you are able to manage risk and the investment exposure you have. Derivatives can be used to protect yourself if things don't go in the direction you expect. Now we limit losses. With hedging, you can limit your losses to an amount that you are comfortable with. The cost of the hedge will limit your gains, but your losses won't increase in the case of a price decline. Now we lock in future prices. Companies use derivatives to eliminate the uncertainty of future commodity prices. By using futures and forward contracts, they can lock in prices for essential goods well in advance of their delivery date. Now, the risk of hedging. Limiting your losses is one of the principal benefits of hedging, but it also means it will limit your potential gains. If an investment increases in value and the hedge is not necessary, you will lose the cost of the hedge. Hedging has a cost. This is either the direct cost of a derivative contract used to hedge or the cost of lower profits in return for some protection against losses. That's it for today, guys. Thank you so much for joining us. Stay tuned for more educational videos. Bye-bye.